Hey, good morning, everybody. Welcome into the Mining Stock Daily long-form episode for this week. It was an incredibly busy week. If you need to go back and listen to any of those corporate updates or introductions, please do so. We put out a number of episodes and a lot of new guests on the podcast this week as well. But we're going to conclude the week going into our Easter weekend and the holiday with an interview with Chase Taylor from Pinecone Macro. Chase and I have known each other for, I don't know, 6-7 months now since our time spent at a conference back in Vail this past fall. I really have been enjoying kind of watching a lot of his content, reading some of his work as well at Pinecone Macro. Plus, he's got a new podcast out that just had me on the floor rolling, which is a breath of fresh air in the macro space right now. So Chase Taylor, great conversation with him. Special thank you to Victoria Gold, Feast Silver, Arizona Sonoran Copper, and Fireweed Metals for their continued support of the podcast. And if you wouldn't mind, hit that like, subscribe, share with people of like-minded interest in commodities, metals, and miners as well. Just does us a lot of good to get in front of new people. So let's get into our long conversation with Chase Taylor, everybody. Have a wonderful weekend. Well, Chase, welcome and thank you for joining me your first time here on Mining Stock Daily, where you're going to divulge everything you know about mining stocks.
Yeah, that's not what anyone wants, but yeah, it's great to be on. I've been listening since we met in Vail, and love the show. So
yeah, well, I appreciate that. It was a good time. I mean, yeah, that you and I both met a lot of new people. Me specifically. I mean, you amongst dozens of others, and I just it's been a lot of fun to get to know you since that introduction and kind of following what you're doing over at Pinecone Macro. In fact, not only do you continue to write some superb content, you're also started a new podcast. In fact, that last podcast you did with Brent Johnson, oh my God, I was like, what a breath of fresh air to hear a macro themed podcast that actually had a bunch of humor behind it. However, I am a little disgruntled with that Nebraska football joke you made.
yeah, that I made 2 Nebraska jokes, so I poured those on a little thick. But the reality is, I have a lot of love for Nebraska.
Good. For anybody interested, you can follow that at Taylor Made Macro, and then we'll talk about a lot of Chase's other work that he sends to his subscribers and his network. But Chase, let's kind of get a sense. Listen, I know this is the first time you've been on, so I'd love to get a little bit of background. I mean, you have such an incredible background. It hasn't all been finance and macroeconomics, although that's really what you've been driven to do in the last 6 or 7 years. In fact, you're actually one of our the pride of the American military veterans. So thank you for that. Give us a walkthrough about your career.
Yeah, so I never cared about finance or economics or anything like that through high school or college. I joined the Air Force in 2006, and then the '08 financial crisis hit. That kind of got me interested, and I kind of caught the bug then, mostly just coming from a place of like, how in the world could this happen? So I started learning about economics, and then that turned into finance, and I just was never able to give it up or look back. But I spent 17 years in the Air Force and just got out almost literally a year ago. So now I work at Bulwark Capital out in Washington State, in addition to running Pinecone Macro Research. Just along the way of, a few years of being a really bad investor and learning. And then the last few years started writing and started the research business in 2018. So somehow that's almost 6 years old now.
Yeah, you're right. What was it about, the last 6 years? I mean, it seems like since COVID 2020, there's a lot of macro voices now, right? Everybody's been paying attention. And so how are you kind of, getting yourself through the weeds and making yourself kind of stand out here? Because even in the mining industry, there's a lot of people out there sharing research, sharing ideas, and, you kind of have to be, you got to stand out somehow, right?
Yeah, big time, especially now. So like I said, the research business is 6 years old. But if I think about what that like industry looks like now versus back then, like everyone has a Substack now. So the competition for, people to read your stuff is pretty huge. And there are a lot of things I could succumb to like really boost readership. And at the end of the day, I just choose to do none of that and just do my thing. I just try to keep my process, tight and as honest and truth seeking as I can. And hopefully some people, want to read it along the way. But I think what does make me stand out though, like I'm just not afraid to make a call. Like you see a lot of research where people don't really make calls, and I'm just not afraid to be wrong. I spent most of last year getting the economy wrong, and then I wrote a ton about how and why I got it wrong and what I thought it meant moving forward. So I think in that sense, it's a little bit different from what a lot of other people do. Hopefully that sets me apart, but
yeah. Well, what happens if that call goes awry?
yeah. So to me, like, you learn so much more from being wrong. So honestly, 2018 through 2022, like I felt like I couldn't miss. And it's one of those things where, in the back of your head when you're getting tons of stuff right, and not just right, but like really right, like your moment out of the sun is coming for you. And last year I got that good and hard. But I learned more last year than those other, 4 years, 5 years combined. So to me, that's being able to go back to tear down your framework to the studs and kind of rebuild it. Like there's more value in that than just getting stuff right, because your ability to go back and look at things you got right and understand how and why and further develop your process from that is it's just hard to do. No one really, gets much better from when they're winning. So I, in a lot of ways, it was torturous last year, but in other ways, like I had more growth than the last few years combined. But before last year, it was mostly just, commodity stuff. I felt like the oil and natural gas bull markets, from 2020 to 2022 were, I don't know if I'll ever get a setup that easy ever again. Like that was, or just inflation going, calling inflation to go way higher in 2020, 2021. Like that, it was just a layup to me anyway. I think 2023 with all the cross currents was significantly harder. And so I stopped getting things significantly right. But so far this year has gotten a lot better for sure.
Well, I think your outlook, your macro outlook for 2024 and probably beyond, is set up in a similar way that I'm looking at the macro outlook. However, you're more of the macro expert that I am. I see things through the lens of the metals and commodity space, and we're going to talk about that in this conversation. But just kind of curious, what were your expectations going into 2023 that didn't pan out? And
Yeah.
and how do you turn those things into a learning moment? It's not just about losing money, it's about learning from those losses. So how did you, what went wrong and what did you learn?
Yeah. So I, I got inflation really right. Like I went from being a really big inflation person in 2020, 2021, 2022 to calling for inflation to go way down in 2023. So I nailed that. Problem is, I also thought that was going to come with a lot of economic weakness. And not only did we not get it, we got quite the opposite. The Fed going into 2023, they thought growth would be 0.9%, and we got like over 3. So they were pretty wrong. And I thought their expectations were too high at 0.9. So that shows you how wrong I was about growth. I thought the consumer would run out of steam and faster than they did. And in reality, in 2023, they didn't at all. So when I go back and look at like, okay, well, how did I get this so wrong? So I thought the policy rate going from nothing to 5.5 would start breaking some stuff. Looking back on it, that was really dumb. And the simple reason is rates only matter if you have to pay them. And the reality is 2023, almost no one had to pay those rates. Everyone termed out financing, in 2021, whenever you could finance everything long-term for free, more or less. So everyone got mortgages under 3%, at least under 4%. If you're a corporation, you termed out all of your bonds, like anyone that could refi straight up. So the exposure to the front end rates that the Fed can actually move, it was just so small. So the reality was that conveyor belt of monetary policy, the thing that you imagine, like the Fed dropping their rate hike in and it goes down the belt to the economy. Well, that belt used to be kind of short and now it's really long. So I just missed that. And it's funny, I was listening to a friend of mine on his podcast, Rob Larity, and he was talking about an old interview with Ray Dalio, and it was like a really lame interview because they asked him, he got the debt crisis in Europe really right, and they were like, "How did you get that so right?" And he goes like, "Oh, it's like, and that's when the payments were due. Like that's when the payments were. Like just that simple. That's like makes for a bad interview, but like it's actually pretty profound." And I realized like there were no payments due. Like of course nothing bad happened in 2023. No one's payments were due. So it really was that simple. And then I've learned, I think, in the last 6 to 9 months, how important stock market returns are as far as the feedback loop back into the economy. I went from thinking it wasn't that big a deal to thinking it's a bigger deal than what feels like everyone else, just from all the work I put in studying the prior impacts. So I think those are some of the big things I got wrong and why I thought growth could be a problem. I was really focused on data that surrounded consumers like under 40, small businesses, regional banks. And that stuff has honestly looked pretty, if you go dig into the numbers on that stuff, it's pretty ugly, and it has been for a year. And I took that and I was like, ooh, this is going to like actually start hitting the real economy. But I think, sure, that it could in a vacuum, but then you throw, multi-trillion-dollar deficits, and the fact that those deficits are now building real stuff in America, like that's pretty stimulative as it turns out. So that stuff has kept growth much higher than, young people struggling has hurt it.
Yeah. You're not the only one that got it wrong, right? I think a lot of people walked into 2023 expecting weak growth. 2022 was really tough for stock market returns, obviously, as that rate hiking cycle really hit its peak. And a lot of people were expecting, things like regional banks to continue to fall, corporate real estate to start trying to, sink under the rising waters. And we still did get that. I mean, and Michael Howell comes in, and he was on this podcast not too long ago. He's on a number one, and he continues to talk how that debacle with Silicon Valley Bank really was kind of the catalyst to move things back. And that's when you needed to stop worrying about interest rates and start paying attention to more liquidity, because the liquidity is really what was continued to drive not only stock market growth, but also production, and real economic growth here. I mean, do you look back on that and that was kind of like, oh God, why? I was so focused on the doom and gloom of regional bank, contagion, that I missed that if they were moving liquidity into the system, then it was going to lift all boats.
Yeah, 100%. And it's funny because I love Michael Howell. I follow his work. I have his book. Like anyone that doesn't follow him and what he's saying, like you really should, because he basically called bottom in October 2022, just nailed it. And he's just been right since. And his liquidity cycle framework has played out exactly the way he has been suggesting all along. And it took me a long time to very stubbornly accept his point that, liquidity is just vastly more important than interest rates. Like there was a struggle for me to like come to that. But it just bears out in the data. Like it just is kind of obviously the case. And yes, I absolutely got sucked into the regional banking crisis, but I think in a different way than other people. As soon as it happened, my thought process was, this is going to really tighten up bank credit, and that will slow the economy. And it did tighten up bank credit. So as like my kind of prediction like played out, I'm like, this is what's going to happen next, and it happened. I'm like, well, then surely my conclusion's also right. But the reality is, whenever the federal government's spending that much money, like it just makes bank credit less important. Like who cares if the bank will give you money if the government will? You know what I mean? Like
right.
if you're splashing $60 billion on one company just for microchip stuff over like a few years, like do they need to go get a bank loan? Like no. Like it made bank credit less important. And I think I was slow to respect how much that mattered in real time. But I will say, even back then, I knew, like, you could just look at the Fed's balance sheet, just rocket shipping higher right after the Silicon Valley Bank thing. And you could kind of feel like, okay, now wait a second. Will it tighten up credit? Sure. But that it's also at the same time making the Fed like really add a lot of liquidity. So you could argue, 2023's investment returns largely owe themselves to the fact that you had regional banks blowing up. As perverse as that sounds, like it's largely true. Because I don't think a lot of people realize, like, we raised interest rates, that was tight in 2023, but the Fed added net liquidity on the year of 2023. So they kind of one foot on the gas, one foot on the brakes, and that foot on the gas mattered a lot more.
Yeah. You had written in one of your latest pieces this year, and you published a couple different publications, but in the Emerald, you wrote some similarities you're seeing now and the cycle in the late 90s with long-term capital management back in 1998. It was just an incredible read. And, um, I've read a little bit of Russell Napier, so a little bit familiar of what happened with LTCM through his writings and looking back at what he went through because he was employed there. But it's really fascinating, and so it was nice to like get refreshed on what was going on with economic growth, with the stock market, with rates all around 1997, 1998, and then LCTM collapses, but the stock market continued its wild ride. Maybe if we could rehash that. I mean, talk to us about that's those studies. You and I are about the same age, so I would say we weren't really paying attention to long-term capital management at the time. I would
Not at
say I
all.
think I was more or less worried about driving my new car when I was 16 around the same time. So but looking back, what are you seeing similarities now with what we saw in '98 with cycles past?
Yeah, I was there with you. My '83 Trans Am was front of mind,
Yeah.
and just playing football. So yeah, getting the T tops out of that bad boy. So um, first and foremost, I you talked about the refreshment. That's honestly why I did it. I wanted to see, like, is there any real parallels here or not? And I came away thinking there were more than I expected, but the whole like parallel absolutely hinges on the Fed making the same mistake they did in '98, which is simply cutting rates into strength. So like markets up, economy up, just cut anyway kind of thing. Although the market had actually pulled back a decent amount back then, unemployment rate had started to move higher, but as soon as they cut, like all that unwound and you just were on a rocket ship. If you go back to the pivot from the Fed, kind of like at the end of the third quarter of 23, markets have been going straight up since. But if you look at it, it's about 1% a week, which is, don't get me wrong, that's really strong, right?
Yeah.
If you go back
Yeah.
to the cuts in '98 through the tech bubble, you went up about a 1% a day on the NASDAQ back then. Like, just like over that whole stretch of time, which is just shockingly, I mean, it's just absurd how much it went up. But it shows you, like, if you cut into to strength like that, that's what at least can happen. And one of the things I wanted to do was go look at financial conditions. So like, and financial conditions, for anyone who doesn't know, like that really just means asset prices going up loosens financial conditions. So what happens whenever those loosen the way they did in the fourth quarter of 2023, because asset prices went straight up, and you kind of plot all kinds of different data after that. You pick the data, macro data, commodity prices, foreign currency, like exchange rates, like pretty much any data, and you add a couple, 3-4 quarters to it after you get that much of a asset price boom, and it all just goes way up. Inflation goes way up, growth goes way up, commodity prices go way up, you name it. So interest rates go way up. Like, so it just kind of shows you like the power of asset markets. And the crazy thing is the NASDAQ is a percentage of the economy way higher now than it was back in the late 90s. So you could argue the potential impact of the market, having this kind of move higher is actually stronger than it was back then. So the feedback loop between markets and the real economy is huge. I mean, a lot of boomers have pretty decent retirement accounts, and you go add another, a few $100,000 to it or a couple million to it for the more wealthy accounts, like they're going to spend a lot more money. Not to mention they can retire earlier, which we're starting to see. And if you retire earlier because your retirement portfolio is doing so great, then that's less labor force, which means wages have to be higher, which is inflationary. So to me,
Yeah.
the whole thing just means if they do cut into strength, they're going to lose control of inflation again. They'll lose control probably of bond yields if they don't step in and buy them. But as we record this yesterday, we had Waller give a speech where he started to back off, and he was really the one that I mean, he planted the flag for the pivot originally. Now I kind of felt like he was planting the flag for like, hold on, like it's because to me, Powell in the last FOMC, like he just did not care at all about the fact that 2 months of hot inflation happened. It
No.
seemed like he was just willing to look through that and cut anyway. And then Waller yesterday kind of gave you the vibes of like, no, I'm taking it seriously. So we'll see how it evolves from here. Maybe they won't actually cut into strength the way it has been looking for the last couple months.
Well, and so you can take that story from 1998 with LTCM, and you can replace that with a number of things. You can replace it with Silicon Valley Bank if you like, or regional banks in general. And here we are with loose financial conditions currently. Asset prices continue to go up. Inflation isn't dead, as you and I, you say, well, this isn't planned, but you and I both like to say inflation ain't dead. Just look
Yeah.
at any sort of commodity graph, chart, and you know it's not dead. You have the talk of cuts, and again, there's a little bit of pushback now within the internally in that committee in the Federal Reserve. But it sounds like we're also in an election year, so things get a little political. Yeah, I wouldn't be surprised to see rate cuts no matter what Waller says. But here we are. I just don't see a situation where asset prices throughout the board go down without something breaking.
Yeah, exactly. It is going to require something substantial. I see potential for like a normal pullback. I have for a long time seen potential for there's so many systematic things layered on top of each other that are all in the same things and all long. Like so, there's also the possibilities for kind of a cascading effect down, but it's a low probability event, right?
Mm-hmm.
At the end of the day, liquidity's high. Uh, Looking at it, I don't see how liquidity gets much worse. Like they're so ready to step in anywhere that liquidity can go down. And I think the Fed and the Treasury have learned a lot in the last decade. So they see these traps ahead of them better than they used to. You used to get events where you're like, oh wow, liquidity is like getting really ugly, and then they step in. Nowadays, it seems like they see it coming before it happens and they're ready. So like they're already talking about tapering the pace of QT, making sure that they don't find that reserve level that becomes a problem. Like that they're walking whenever they hit that, not running into it. Things like that. So it's kind of they're tracking the reverse repo facility so close. So like everywhere that they could kind of step on a rake, it seems like they're they have their eyes wide open. So that tells you liquidity is probably going to stay high, which tells you it's going to be tough for asset prices to move much. And to your point, like we had 7 cuts priced in, now it's 3, and the market's up a lot since then. So like the market doesn't even care that it might not get those cuts so far. Now, and you could argue, I think, that if we're always like just about to get that cut, the market will love that. And I even think there's some arguments that you might say you get that first cut in June, but the Fed's like, but I don't know if we're going to do anymore. Like that could be like where you could get, a pretty decent pullback. Like you finally get, the dog finally catches the car, and then it's like, I don't know what to do with it now. Like you got your cut. Congratulations, rates are still over 5. Like now what? You know what I mean? And if inflation, like it's hard to remember for some people, I think, but inflation and rates going higher, like that's what made, that nasty kind of move down in 2022 that was bigger than people probably remember. So if inflation kind of unleashes itself again, you'll feel it in the economy and in earnings and stuff, but you'll also, there's a decent chance you feel it in asset prices. So it could calm asset prices down, even though it's hard to see any sort of like major, bear market coming up anytime soon.
Yeah. Well, and it'd be interesting if we do. I mean, you and I think, both believe it sounds like that we are going to get a meaningful next wave of higher inflation. What the response by the central bank and the Fed is yet to be seen. But I also, I look back in the last year here, Chase, and I'm like, at 5.25%, we're doing just fine. Obviously, growth remains abundant. And it's like, why did we need zero interest rate policy for so
Yeah.
long? And I mean, obviously it's hindsight, but like you're talking 20 years of this nonsense. And it is just like a drug. Now everybody's like, oh, we're going to go back to, very cheap interest rates. It's like, well, I don't think we are, because look at the inflationary data. Go look at agriculture prices, food prices, go look at metals prices, industrial prices. Like everything's ticking higher. And so what the response is, come this fall into an election, which would be interesting and insane, is yet to be seen. But it's like, couldn't they keep it at 5.25? I still don't. Even if they keep it higher for longer, higher into 2025, I still don't see it having much of a meaningful effect as far as falling asset prices. I think people are like, well, we've managed this long, so let the party roll.
Yeah, I would say I do think you'd have some problems, but it more like finance problems than like hardcore real economy problems. So
Right.
there's been a lot of extended pretend in commercial real estate, private equity, um, even normal small businesses that have their financing tied to SOFR. Um, and hey, nominal growth's been like 5, 6, 7, 8%. So even if your interest rate's going up, like your earnings are doing well enough to where you can make it. But I think if you pushed into like 2025 with 5% plus rates, the ability to extend and pretend and keep rolling and give like private equity guys giving themselves a loan to their own portfolio companies, stuff like that, that just gets tougher. So I think you would start to see some blow ups in private equity and in real estate that would matter, but none of those, at least from my perspective at the moment, are enough to be systemic or like take down the whole economy and have to bring in the Fed to slash rates or anything like that. So
Yeah.
I think having those rates that high into 25, yeah, you could have a real slowdown, maybe even a recession from it, but nothing, no like crazy '08 stuff that seems possible to me just based on rates being higher.
Yeah.
As long as fiscal is as high as it is, like it's just kind of natural for rates to be up here. And I'm of the opinion that the natural rate of inflation is significantly higher than it used to be. I think secular inflation just very naturally wants to be a lot higher than it was in the years prior, for a bunch of very big moving secular forces that go back 40 years, like 3 or 4 things that are reversing that trend. So the pressure there is huge, and the Fed clearly does not recognize that yet. And I think there's slow adjustment to the fact that growth and inflation is just going to be higher than it was, the last 20 years. Their slow reaction to that is going to be a very tough transition for a lot of things, like rates
Yeah.
having to, like the 10-year treasury yield having to move higher and stay higher, policy rates having to move higher and stay higher. All this stuff is going to just be different for them.
Yeah. Uh, but long term, the thing I really appreciate is you can think very, very long term, like 20, 30 years down the road. In fact, you're starting to think about demographics in a very meaningful way. I've probably been reading a little bit of Zion as well. She's been feeding into this thought. But, it was interesting in this one note you wrote about demographics and how long-term demographic changes are in itself inflationary. You just kind of wrote down, like, people like you and I, when we're of the age of 60, so, let's just say 20 years from now, there's going to be less people in the productive world and more on the services side to take care of us old farts,
Yeah.
which is in itself hard on growth, but also, inflationary in itself. It's just fascinating.
Yeah. I mean, we already have a labor shortage for elder care, and we have 4 million baby boomers retiring per year at the moment. So like that problem just gets bigger. And I think what you have to pay people, because you're gonna have to go pay Gen Z and millennials to take care of the boomers, what you have to pay them to do that is just really high, and that's going to put pressure on wages. But just the fact that the boomers are leaving the workforce in large numbers, you either more or less fill that gap with immigrants, or you kind of don't fill it. Um, and it's not that difficult to see immigration policies at some point in this populist era, being pretty restrictive again. And if that happens, you just have to pay people more to do work, because there's not enough people to do the work. Unless obviously, AI robots take over all the work and then 2 years from now or something. But I would be surprised if it was rapid enough to take care of this. I think you've had this fear of AI taking all the jobs, and I'm looking at it like you better hope so, because if not, like there's nobody to take them, and wages and inflation have to like really go up in order to take care of that. I think traditionally people view aging populations very deflationary. People retire and they stop spending, and they just sit there and don't do anything. I view it the other way. Like boomers spend a lot of money in my experience, and I think that the data shows that they have a lot of wealth. They spend a lot. Um, they have tons of exposure to the stock market, so I don't see them, really pulling back on their spending hard. And at the same time, like, are they going to save less? Of course, like they're going to start consuming the capital they saved. But what does that mean? It means that's less capital provided to capital markets. That means they're buying less treasuries. They're buying less equity. Like, so that makes the cost of capital go higher. So to me, like all this is inflationary. And as a species, we've never dealt with systematic falling population. And that, speaking of long run, like we're still probably 20, 30 years from global population moving lower, but the whole developed world's already there. I mean,
Right.
it's very bad in Asia, and Asia has been, the kind of global provider of A, capital, and B, low wage labor. And both, I mean, obviously less people means less low wage labor. Geopolitics is suggesting less offshoring to them to begin with, and then they're taking their money and they're going home. So that all of that means higher interest rates and higher inflation to me.
Yeah.
They're huge forces.
Yeah, and not that I don't want to get conspiratorial or anything, but the immigration situation. I mean, right now, currently dire. It's just an absolute mess. How we let it get to this point is beyond me. But I mean, you can see the politics behind immigration, the need and the reason for it, and you just look at the demographic data. You got to fill that void somehow, right? Not saying this is the best way to fill it the way it's happening now.
Yeah,
However,
certainly not. Yeah.
You can see the reason to allow more people to come into the country. I mean, this is just kind of battling cycles, natural cycles of itself. But man, I don't know. No, I don't want to open up a can of worms here that we typically don't talk about.
No,
But
I will say
you
though,
can see it.
I think competition for this is going to sound bad, but I'll say it. Good immigrants is going to be through the roof 20, 30 years from now. Whenever all these countries, like populations are falling, dramatically, and their growth is falling because of it and with it. All of a sudden, the best and brightest people coming out of like India and Nigeria, like you're not going to be like, hey, this is how many of you guys can come in. Like, here's a lottery system. Maybe you'll get lucky.
Mm-hmm.
It'll be like you'll be on a recruiting drive in Nigeria to find like the smartest people to be like, please come to our country. Like, don't go. No, you don't need to go to their country. Ours is better. I think that's where we're headed in 25 years because of population decline.
Yeah. In fact, it's funny you mentioned that, because I started reading Chip Wars by Chris Miller. I don't know if you read it, but I'm just into like
It's up here.
I'm just into the first couple chapters. But he had written a lot about the sharing of scientists and engineers following World War II with both the Japanese and Russians. Well, some of those Russians engineers turned out to be KGB spies, obviously, but yeah, I mean, there was this kind of, after such a terrible event that had concluded, kind of coming to grips with how to advance production, engineering, scientific technology amongst each other, and allowing a lot of those very brilliant people on whatever side of the border they lived on to come to the U.S. or into Japan, and work together to try to develop that. I don't think we're anywhere close to having that type of relationship right now, but maybe when we get through whatever this cycle, maybe it will we can do that, as you mentioned, talking about.
I have a fun story for you there, going back to my Air Force time. I worked at the Air Force's rocket laboratory, and that's in the Mojave Desert in Southern California. And it was essentially founded on the work of a Nazi rocket scientist that we we removed from Germany an Operation Paperclip. So like the early rocket work we were doing there was straight up off of, the best and brightest that came out of Germany. Um, and that's like a very controversial piece of history, but you look back on it and like they had some pretty great scientists and engineers, and like us like doing that, like being smart enough to be like, all right, look, these people were too smart to not use, like, and bringing them and using their research was, I mean, it was instrumental in our technical advances in the, call it 50s through 80s. Like it was a big deal. So seeing it firsthand, the impact it can have.
Yeah, absolutely. Um, let's talk some commodities, because it sounds like you've been paying very, very close attention here lately. In fact, you and I have had some off the record conversations about silver. So I'm sure all those silver bugs' ears are going to start perking up here in this conversation. But maybe general sense. I mean, I wanted to talk to you about silver, obviously, and copper. We got to talk about this move in precious metals. But, you know, if you needed one data point that shows you that things continue to be inflationary, just look at the commodity charts. I mean, how are you watching this, and why? What is the fuel behind this move?
Yeah. So what's most interesting to me on the recent strength in commodities is the fact that it's doing it without much dollar weakness. Like we had a little run lower in the dollar and the commodity started to perk up, and then the dollar started going back up, and commodities are like, yeah, whatever, we're just going to keep going up anyways. So that stood out to me. Um, the reason I love commodities is because they're simple. They're more or less supply and demand. There are some small overlays of other things, but if you can get the supply and demand largely right, you can get the rest right. And I think most of them, it's really just a supply and demand thing. Like the global economy's picking up. There's rate cuts starting to happen all over the world. They've already been happening in emerging countries for a while. You have the Chinese economy going from terrible to just bad, which is a huge deal. You have significant growth coming out of India, obviously. You have Southeast Asia, like always just kind of ready to just go on a rampage, in my opinion, as far as growth goes. And that is a ton of commodity consumption. You have the whole world just falling over each other to hurry up and, green their grids and their industry. And that requires just shocking amounts of battery metals and copper. Like you can only read that stuff so much. It's so hard to understand the real impact of how much like offshore wind turbine, like how much like copper and cement and everything they use. Like it's crazy. The fact that copper is doing what it's doing right now, which has in the last month, is really, it's broken out in my opinion against the backdrop of Chinese property, which is about 20% of global copper demand. Like that tells you a lot about copper demand and supply, but outside of just that traditional demand profile of, well, how's housing doing in China? That's all he really cared about. Now all of a sudden, all of the grid work that's being done and everything's starting to matter just more and more every day. And we get reminded, like we did in Panama, like how difficult it is to get it out of the ground, and how much of it is tied to regions of the world that are difficult to get it out. I mean, a lot of it's parked right next to indigenous people and like really nice landscapes that people care about. Like it's not straightforward to mine this stuff, and it takes a ton of money and a ton of time to mine this stuff. So you look at where demand appears to be heading, and then you look at where supply appears to be heading. And those two things don't add up for very many commodities at all. And I think part of this is just now the demand's picking up because global growth's picking up. People kind of look back at that supply picture and go, oh yeah, we don't have enough in a few years. That's right. Like part of it's that simple.
Do you believe in a big copper super cycle solely based on Chinese demand, or do you think this thing is going to be based on global demand?
I think the super cycle will be tied mostly to the difficulty of getting it out of the ground, largely.
Just supply.
But yeah, I think global demand, like, and if we continue to do what we're doing with a surge in just needs for electricity, and not to mention the preference for what kind of electricity, as long as those preferences remain, hey, let's keep it renewable as much as possible, and we need a lot more for things like data centers. As long as those trends
Yeah.
stay even kind of intact, like you just need a lot more copper, you need a lot more aluminum, you name it.
Yeah. Tin. Need a lot more tin. Been
Yeah,
saying
I
that.
mean EVs,
Yeah.
the density of commodities and all of these new technologies versus the old technologies, just it's mind blowing the difference.
Yeah, and I have been kind of harking on this a little bit, Chase, openly about we talk about uh infrastructure stimulus when we think about roads and unfortunately bridges now, and the like of just everyday infrastructure. But I think what's missing, well, maybe it's not really missing, but I'm very curious about the demand of our digital infrastructure in the future, about data centers. I mean, listen, I always laugh. A lot of our own, the uranium bowls, even the silver bowls, will somehow say, AI is going to be driven by uranium, nuclear power, or even silver. It's just, you know, whatever, whatever bull case you need. And that is commodity. But I do think the general idea is, how much of these data centers will there need to be constructed in the future? We'd need to talk about that digital infrastructure and how much raw materials is it going to take to power that. And I think a lot hasn't really necessarily been calculated well enough to quite understand just how big this is going to be.
Yeah, and it's very big. I've done some math on it, and it's shocking to be honest with you. But I think a lot of the projections that are out there, like you have to be way more conservative than a lot of the numbers. You have to assume that all of this infrastructure will get more efficient, and I think it will. And for me, like I think AI is cool and it's useful and it will make big changes. It's important, yada yada yada. But I think it's overblown too. I think
Mm-hmm.
what I see out of current AI technology is a really good search function for knowledge workers. Other than that, like the whole large language model thing, like I think it's being very much oversold. So I think the build out of some of that stuff, after the hype cycle here and is over in the next couple of years, like it will slow down. But I mean, data centers in general, like it's not like technology is getting less data adjacent in the future, no matter what. So we're going to need more data centers, and those data centers, like the newer chips, take more power. Like it's just that simple, right? So
Mm-hmm.
unless they make them shockingly more, effective, like efficient, like you're going to need a lot more power. Like, and I moved here to Washington from the DC area, and Northern Virginia. DC is like basically the hub of the whole world for data centers, and you could see it there. Like we had our power from Dominion, and for in order for them to give us our power, they had to start telling the data centers stop building data centers. Like we are running out of electricity, um, and they have huge projects for new transmission lines, new plants, so all of it in the works. But it takes time, and the NIMBY wars over things like the power lines are huge. Like so,
Right.
a lot of times you get caught up in courts for 5 years just to get your power lines through, right? And they don't need the power lines in 10 years; they need them yesterday. So a lot of this is very real. And if you assume you don't want to lose any wars that are tied to this, whether it's AI or quantum computing or whatever it may be, biotech stuff tied to it, like, and I assume the U.S. doesn't, like, you're probably going to find a way to to create the power and streamline it. So just in general, like electricity demand has basically been flat in America for the last few years, and now it's starting to reaccelerate higher. If it was on a stock chart, it would look like a breakout. So I don't think many people are thinking about where all that's going to come from 3 years from now, 5 years from now, if the growth is even half of what it looks like it might be.
Yeah. Well, it'll also be interesting to where that energy demand growth is centralized. Like I keep on thinking, like a lot of these data centers are being constructed in rural areas that do have cheaper power. Midwest, for example, but that's going to require more power. So where's that? Are we going to see an influx of power demand in places like Missouri or Kansas compared to Washington or Colorado? Yeah, just keep. I
Right.
mean, it's
And
just I have an open-ended question here.
Yeah, and we have seen them start to spread out. They're popping up more like in places like Georgia, Oregon, so, and there are some in the Midwest, like for sure. Like so they're moving around. They, like you say, I mean, they like cheap energy, and but also they like, energy that stays on, because the ones that are tied to renewables tend to have like immense amounts of backup power, which are
Yeah.
often like diesel generators. Like, you know what I mean? Like,
Hmm.
or they like to go tie themselves to dams, which makes perfect sense, to hydropower. But then there's a lot of talk here on the West Coast of like, let's get rid of some dams because it would be cool if we still had salmon for our grandkids, things like that. So like maybe they're making a mistake by over anchoring to cheap hydro at the moment. So there's a lot of big question marks moving forward. I think really close to my hometown, we just saw a ton of solar panels just get destroyed by like a hailstorm down in Texas. And kind of a good example, like if you were a data center and you were relying on that, like you have a massive problem all of a sudden. So to me, if I'm a data center, like I need to be tied to gas or nuclear to feel really good about myself. Um,
Hmm.
until battery technology catches up to where it can really store things effectively, assuming we get there. um we are starting to see more and more major companies tie their data centers to nuclear in one way or another, and at some point I think small modular reactors are kind of the natural answer, like, or micro reactors. Like, you don't need to tie into the grid, you just have your own little reactor, and that does everything you need it to do. Like, that's years in the future because our regulatory system's not wonderful for that. But I and we haven't got to where those things are cheap yet. But I think that day will come.
Yeah. I mean, why not build these things next to coal-fired power plants or some gas power plants that were converted from coal, something along those lines. I
Right.
mean, that's obviously a really great solution. Chase, a fascinating conversation. I just, trying to wrap things up here, you know, in the grand scheme of things, obviously we're going to have, if Waller kind of gave us a little bit of a head fake here the last 24 hours
Yeah.
as we're talking, but heading into this June meeting. Oh, there you go.
Yeah.
You got the
Yeah.
entire script.
Yeah. It's top of mind for me.
Yeah. Yeah. Well, I mean, heading into that June meeting, I mean, there is still a little bit of anticipation that that's when that rate cut will happen. I don't know exactly what the odds are right now, but by the market. But I think we're going to get a lot. We're going to get a lot more data before that. I mean, what are you kind of watching here very closely? Is it more of that Fed speak that you're going through with the fine tooth comb, or is it a lot more of just the data that supports or does not support a rate cut?
Yeah. I mean, I unfortunately pay a lot of attention to the Fed speak, but the reality is, like, I that's more of like a 3 maybe 6 month moving average on the data at the end of the day. Like, if the data starts
Mm-hmm.
trending, then they start moving in that direction. So it's more important to look at the data, and even more important to look at where you think the data will go. So that's what I spend my time on, which is honestly mostly growth and inflation. Um, Growth has slowed down, but it still seems fine. We've had two bad retail sales prints, so that's all of a sudden becoming very important. Like, if that keeps eroding, well, maybe growth can erode. So I'm watching that closely, but most of it's inflation, which means, you know the price of gasoline is a big deal to me. The price of labor is a really big deal to me. Things like that. So the next few inflation prints are huge. So Waller went out of this way to say, like, he wants 2 months, 2 more months of, like, okay, like, this isn't bad before he does anything, which means he's saying he won't vote for a hike, and he's important, until July.
Mm-hmm.
July is the first month that's like kind of fully priced for. By then we have done it. Like, it maybe happens in June, maybe happens in July, but July is the first one where it's like, okay, one is priced in. So we only have two more PCEs after the one tomorrow, between now and then. So if April or May's inflation doesn't cool back off a good bit, then you're probably not going to even cut in July. And then after that, you only have 4 meetings to do 3 cuts right into the heart of the election. That just gets tricky. So I think the math, even on 3 cuts, is pretty tough right now. Especially if you want two good prints. So, hey, maybe the April inflation print's not bad, and the Fed's like, all right, we got it back on track. We're going to cut, and then but if May comes in hot and the comps get worse, for the year over year lapse, then after the May one, it gets really hard to cut before September. So I think a lot of these cuts can erode themselves. The market either doesn't need to care, or it just hasn't noticed that it needs to care so far, because really no reaction to Waller. To me, that his speech was huge. It was very important. He's, like I said, he's the one that planted the flag for the pivot, and now I feel like he's kind of like at least planting some seeds for an unpivot, and the market has not at all cared so far. But I think it's going to have to, especially obviously if Powell kind of starts to parrot what he said, and especially it's one thing to look through 2 hot months of inflation. It's a whole other thing to look through 3. So if the next print is again pretty warm, I think the Fed will start changing their tune in a pretty big way.
Is
So all that's
October
front
the
and
last? Sorry, is October
Go
the
ahead.
last opportunity for them to cut before the election?
They have, November 7th is the Fed meeting. So yeah.
Right on election day? Isn't that election? What is or is it?
Yeah, I
What
don't even
day
know.
is election? It's like, wow. Well, I mean, I guess maybe September. I mean, maybe if they do it in October, it's way too political. You think they just do nothing in October?
So I will say, I like doing a 25 basis point cut after you rip this high, like close to the election. To me, like it's not that big a deal.
Yeah.
I've seen a lot of people say like, oh, they would never do that. It's so political. Like, I don't. Yeah, they will. Like, if that's what needs to be done, they'll do it. Like, now are they going to try to like slash rates right before or something? Like, that would be political. But 25 basis points doesn't really change much. So I don't think they would shy away from doing it close. Now, would they shy away from doing 50 or something like that if it wasn't like the economy falling off a cliff? Yeah, of course. But I think they would do a 25 cut within 2 months.
I haven't asked you about gold, but right now the front month is sitting at $22,241, new all-time high here, Chase. What's gold telling you? Why is this move happening?
So what's most important about gold to me is the fact that people are struggling to explain it. And that's everyone from just normal macro people and investors all the way to like gold people, like, are struggling to explain it. That, even if I didn't know anything else, that's all I need to know. And I'm struggling to explain it to a degree. I think a lot of it is people in Asia writ large need a safe haven. I think you need it from deflation in China. You need it from inflation in Japan. You need it in Japan from the fact, and I give Weston Nakamura credit for this thinking. The yen has been a safe haven currency basically our whole life, right? Well, now all of a sudden and it's fine if the yen goes down whenever you have no inflation. Now they have both inflation and a falling yen. That's like a double-barreled like shotgun on your wealth. So I think Japanese investors are discovering gold, which is kind of new, and they have a lot of money. If you're not familiar, folks, they have a lot of money. So if they kind of turn their gaze towards gold, and maybe they are, that is a huge new demand source. And as we know, central bank demand has really gone through the roof for a 3rd year in a row. Everyone keeps predicting to go back to normal, and it keeps not. And I don't think it's going to. So central bank demand, I think, is the biggest driver, but also I think demand coming out of China and Japan is pretty significant. And obviously some other places like Turkey and Latin America that have had inflation problems. Those people want to buy it. Like no one in Europe or America even cares yet. So if they start to care, it just becomes that much bigger of a deal. So I think this move's real. The fact that it's broken out on little little data or indicators that you can point to just makes it that much more important and powerful to me.
All right. Great conversation, Chase. I'm so happy we can make this happen. Where can we find all your work? I mean, obviously pineconemacro.com, but give us a sense of where else the other avenues that people can search for you.
Yeah, that's the problem. I do too much work, so there's too many places to find me. But yeah, for people that want the research, pinecomemacro.com. On Twitter at Pinecone Macro. As you already alluded to, the podcast is Taylor Made Macro. And then I work at Bulwark Capital, so Bulwark Capital Management, and that's mgmt.com. And we do a daily podcast there, so my podcast calendar is full too. But yeah, you can find all that stuff and pick the way you want to kind of keep up a little bit.
Yeah. I hope you can keep up the same kind of feel with the Taylor Made Macro podcast, because
Just wait till you hear the second one.
Oh my God. When you asked Brent Johnson if you like the dollar so much, why don't you marry it? I about lost it. It was so funny.
So real quick for listeners that if you're familiar with Zach Galifianakis's Between Two Ferns, like I tried to model the segment in the middle of the show after that. I call it Between Two Pines, and it's honestly just for me to kind of roast my guest if I know them. Eventually, I have some people I don't really know well, and that would just be too awkward. But the next episode will come up here in like a week or so, and I had Kevin Muir on, and I had a real good time with him on Between Two Pines. So I think people are gonna have a blast.
That's awesome. Well, I hope the mustache continues to make a presence in all your video work.
This is Mustache March for March Madness. So as long as my Houston Cougars are alive, it stays alive.
Did you have the mustache in the Air Force too?
For March, so we actually, it was a thing to do Mustache March and No Shave November. So it would make its way out. Although in the Air Force they have like very strict rules on how you can keep it. That translates to like it makes it look terrible and it's not fun. So I had one that 2 months a year, but it was a bad one. This one's a lot better.
Well, you look great. You look great. All right, Chase Taylor, everybody. That's a wrap here this week. We got a holiday week here this Easter weekend, but we will be back Tuesday morning with the morning briefing. Have a great holiday weekend with your families and loved ones, and be well. Thanks, Chase. Take care, buddy.
Thank you.